Tonight, I want to run this like a real investigation, not a fear marathon, and I'm going to start with the headline everyone already thinks they understand. Insiders are selling. You've seen the screenshots, the viral posts, the clips that zoom in on a famous billionaire's name like it's a prophecy. And I get it, because it feels like a secret door just opened. But here's the twist that most of those videos never deliver. The story isn't that insiders are selling. The story is that insiders are selling, but not where you think. And when you finally see where the heavy, meaningful selling is clustering, and where buying has quietly disappeared, the whole market starts to look different, even if the index is still floating near highs. So in the next minutes, we're going to build an evidence board. Every 30 seconds, you'll get a clue you can actually use, but I'm going to hold the master key until the end, because the master key is what makes all the clues click into one picture. If you stay with me, you'll see why the loud story about celebrity insiders is often the least useful part, and why the quiet story, the one happening in boring corners and uncomfortable balance sheets, is where risk tends to show itself first. Quick ground rule: this is not financial advice. This is education and pattern recognition. I'm not telling you to buy or sell anything. I'm showing you how the game is being played so you don't get played by the narrative. Now, clue number 1. Most people read insider selling like it's one single signal. It isn't. Insider selling is a category that includes routine, mechanical selling that happens because of compensation, taxes, and scheduled plans. And it also includes discretionary selling that can be informative. The first filter is not how much. The first filter is what kind. Executives in the United States often sell under something called a 10b5-1 plan, which is a pre-arranged trading program that can schedule sales over time. That means some of the most dramatic-looking sales are not a sudden decision made today because somebody woke up scared. They are part of a machine. So if you want to think like a detective instead of a tourist, you don't gasp at a headline. You ask, was this open market discretionary? Or was it scheduled, option-related, sell to cover, or part of a plan that was filed earlier? That's clue number 1. A lot of selling is noise dressed up as signal. Now clue number 2. If selling is noisy, buying is quiet. In markets, insiders sell for many reasons, but insiders buy for fewer reasons. Buying is optional. Buying is conviction. Buying is reputational. And that's why the most honest mood in insider activity isn't how much insiders sell. It's how willing insiders are to buy at these prices. When insider buying thins out across the market, especially when prices are high and narratives are euphoric, that isn't a guarantee of a crash, but it is a shift in the character of risk. It means the people closest to the cash flows are less excited about owning more of their own stock up here. And here comes a question you should keep alive as we move forward. If insiders aren't buying the rally, who is? Hold that, because it matters more than you think. Clue number 3. The market can rally while insiders sell because the market has other buyers. And one buyer is so big, it changes the entire ecosystem. Corporate buybacks. When companies buy their own shares, it creates a steady bid. It can smooth drawdowns. It can support the surface. It can keep the index looking calm even while the internal map changes. This is why you can have a year where insider selling looks heavy and yet markets don't immediately collapse. The surface is being supported.
And this is where most people panic at the wrong time for the wrong reasons. They think selling equals immediate doom. But in real life, selling plus buybacks plus passive flows can equal a long, weird period where the tape looks healthy and the inside of the system quietly rearranges. That brings us to clue number 4. And this one is the first time the title becomes real. People hear insiders are selling, and they immediately picture one place: mega cap tech. The most famous names, the most viral tickers, the most crowded story. And yes, there is often heavy selling in crowded story sectors because high prices create liquidity and because crowded narratives create a perfect moment to reduce exposure without spooking the market. But the deeper truth is not just sector. The deeper truth is mechanism. Insiders don't only sell stocks, They sell certainty. They sell the assets that only work if the future stays clean and smooth, if refinancing stays easy, if profit margins stay elevated, if consumers keep spending, if nothing breaks, if rates behave, if credit stays friendly. When the world becomes messier, even if it's not officially in a recession, the distribution of outcomes widens. And when the distribution of outcomes widens, the market's pricing of perfection becomes dangerous. Not because a crash is guaranteed, but because the downside becomes fatter while the upside becomes limited. That's why insiders often reduce exposure at highs. Not because they can time the top, but because they can see asymmetry. Here's a simple example you can feel in your bones. If you are already wealthy, missing another 10 or 20% upside hurts your ego more than your life. But getting caught in a 40% drawdown hurts your future optionality. So you de-risk. That's human. Now, clue number 5. The most important insiders aren't always the celebrity founders. Founders can sell for lifestyle, philanthropy, and long-term diversification. The players who often see stress earliest are the ones whose job is to stare at ugly balance sheets and ugly cash flows. Finance teams, treasury departments, risk committees, lenders, insurers, credit analysts, and CFO offices. They see the machinery. They see the cost of capital. They see rollover schedules. They see default probabilities. They see which customers are weakening, which categories are slowing, which ad markets are tightening, which enterprise budgets are freezing, which receivables are stretching. These aren't vibes. This is internal data, and it hits before headlines. That means when you are tracking insider behavior, you should care deeply about who is selling. A CFO trimming can sometimes tell you more than a founder trimming, because the CFO lives at the intersection of cash flow and reality. Now, clue number 6. Look away from the celebrity list and watch the stress chain. When money gets tight, pain usually appears in a pattern. First comes refinancing risk, because short maturities meet higher rates. Then comes commercial real estate rollover risk, because office vacancy and repricing can crush collateral values. Then comes regional bank stress, because banks that hold loans against falling collateral face pressure from both sides, asset values falling and funding costs rising. Then consumer credit softens, delinquencies creep, and only later do equities fully price it, because equities are the last storyteller in the room, always optimistic until optimism becomes expensive. So ask yourself, if insiders are seeing risk, do they sell the entire market equally, or do they reduce exposure where this chain hits first? That's the heart of the not where you think. The press loves a tech narrative. The system often breaks in credit first. Credit is where reality speaks. Stocks are where stories shout. Now, clue number 7. Consolidation is a smell. Not always a bad smell, but a smell. When an industry enters a wave of mergers and acquisitions, it can mean the easy era is over. Margins are pressured, and scale becomes survival. That's why watching financial sector deals and activist pressure can be part of the same investigation as insider selling. When the macro environment shifts, industries rearrange, and insiders inside those industries often act before the public narrative catches up. Now, clue number 8. When you see heavy selling, don't ask, what do they know? Ask, what are they replacing it with? Because money doesn't vanish, it moves. If exposure is reduced somewhere, it's often increased somewhere else, or held in cash, or rotated into defensive cash flow, or parked in instruments that behave differently. And here's where most viewers miss a key point. The rotation does not always look exciting. It can look boring. It can look like small, quiet purchases in industries that never trend on social media. It can look like healthcare clusters. It can look like energy and cash flow. It can look like balance sheets with low debt and pricing power. It can look like things you can hold through turmoil without needing perfect conditions. Again, not advice, pattern recognition. Now, clue number 9, markets are not one market. When someone says the market, they are often hiding the truth that leadership can be narrow, that a handful of names can drag an index upward while hundreds of names quietly lag,
and that the public can feel either euphoric or miserable, depending on what they own. This is why sensational, everything bubble narratives can feel true and false at the same time. If you own the winners, it feels like a boom. If you own the average stock, it can feel like a grind. When insider selling clusters in the most crowded stories, it can coexist with insider buying clusters in overlooked corners. The map isn't one arrow, it's a heat map. And now we're close to the master key. But before we unlock it, we need one skeptical intermission. Because every good investigation needs a skeptic. The skeptic says, insider selling is normal, and the presence of selling doesn't prove anything. And the skeptic is right. Insiders sell for taxes, diversification, and planned programs. Many large sales are scheduled. Many are part of compensation cycles. If you blindly copy insider sales, you'll panic at the top and miss years of compounding. So what's the solution? The solution is to stop worshiping single data points and start watching relationships. Watch clusters. Watch changes in behavior, not one-off events. Watch the ratio of buying to selling as a mood indicator, not as a prophecy. Watch which sectors show heavy selling while buying disappears. Watch the credit plumbing. Watch the degree of perfection priced into narratives. And now, the master key. Here it is, the thing that makes the whole story click. The real signal in 2025 is not insiders are selling. The real signal is the gap between three forces. 1. How expensive confidence has become in certain parts of the market, meaning how much perfection is priced in. 2. How reluctant insiders have been to add exposure at these prices, meaning the thinness of broad-based insider buying. And 3. How the market is being supported anyway through structural bids like buybacks and passive flows. That gap creates an environment where the index can look calm while risk migrates underneath, and where the most meaningful insider behavior is not the loud selling by celebrity names, but the quiet absence of buying across wide sections of the market, combined with concentrated selling in crowded narrative zones and selective buying in pockets that do not match the mainstream hype. That is why the title is true. Insiders are selling, but not where you think, because the where is not only a sector label.
The where is the intersection of narrative crowding, valuation perfection, and sensitivity to the stress chain. The places that break when expectations reprice, not necessarily when the economy collapses. So how do you use this without becoming paranoid or getting baited by doom content? Rule 1. Treat insider selling like weather, not like a calendar. It changes. It matters, but it doesn't tell you the exact day of the storm. Rule 2. Track insider buying as the rare signal of conviction. Rule 3. Look for clusters and changes in behavior. Rule 4. Learn to ask, what breaks first, and follow credit and refinancing pressure, not just headlines and price. And now I want your input, because this is where we turn the video into a living investigation. Comment bait number 1, fast and simple. If the next surprise does not come from mega-cap tech, where do you think it comes from first? Banking, commercial real estate, consumer credit, corporate debt, or something else? Drop one word only. Banks, CRE, credit, debt, or other. Comment bait number 2. What is one real-life sign you've noticed in the last year that makes you more cautious or more confident? Wages, rent, groceries, job listings, debt, or spending? And if you want part 2, where I build a weekly evidence board, pulling the latest filings, the latest clusters, the latest sentiment shifts, and the one hidden metric I think matters most in the next phase, subscribe, because I will keep it grounded. I will show you the receipts, and I will avoid the clickbait prophets who pretend certainty is a strategy. Final reminder, this is not financial advice. It's education and pattern recognition. Stay curious, stay skeptical, and don't let a headline steal your thinking.
All right, let's keep going, because we've only built the frame, and now we're going to fill it with the kind of evidence that makes this feel real, useful, and impossible to click away from.
And I want you to notice something right now. The reason this format удерживает внимание is not because it screams crash. It's because it keeps asking the right question at the right time. So here's the next question. If insiders are selling certainty, what does certainty look like in a market? It looks like a story that everyone agrees on. It looks like trades that feel safe because they've been working. It looks like a narrative so dominant that people stop checking the assumptions under it. And in 2025, the easiest example is anything priced for perfection, anything that needs a clean macro environment, and anything that depends on cheap refinancing staying available forever. Now we add evidence card 1 on the board. The perception that everything is fine because the index is fine. This is where almost everyone gets fooled, because indexes don't reflect the average company, and they don't reflect balance sheet fragility. An index can be strong while dozens of industries are repricing risk quietly underneath. So card 1 is, index strength is not system health. Keep that in your head because it makes the next clue hit harder. Evidence card 2. The difference between selling and de-risking. People treat insider selling like a binary, like either someone is bullish or bearish. But most smart operators aren't trying to predict the exact top. They're trying to reduce exposure to tail risk while liquidity is good. That means you can have insider selling that's not a call, it's an insurance policy. It's someone saying, I don't need maximum upside, I need maximum optionality. And that changes how you read the action. Here's the question that follows. If they're building optionality, what are they preparing for? Not a single event. A regime shift. And a regime shift is when the rules that made the last 2 years work start to weaken. Which brings us to evidence card 3, refinancing pressure. You don't need a meltdown for refinancing pressure to matter. You just need rates to stay higher than the old era for longer than businesses planned. Imagine you borrowed in the cheap money era with the assumption you could roll that debt smoothly. Now you come back to market and the cost of money is higher. The underwriting is stricter and the lender is nervous. That doesn't break every company, but it breaks the naive ones, the leveraged ones, the ones that were only healthy because money was free. Now pay attention to this micro clue. Insiders and directors inside credit-sensitive industries tend to see refinancing pain in advance because they live in CapEx plans, debt schedules, and covenant discussions. And this is where you think gets tricky, because the market often loves the story that growth is unstoppable while the balance sheet story is quietly turning. So here's a hook you can replay anytime. If a company's stock is priced like everything will be perfect, but its debt has to roll at worse terms, you are looking at a mismatch between narrative and mechanics. And insiders tend to sell mismatches before the public notices them. Evidence card 4. Commercial real estate is still a slow-moving stressor, not because it's the headline of the day, but because it's a maturity problem, a rollover problem, a repricing problem. People hear commercial real estate and think of empty office towers, but the real issue is that a loan that made sense at one rate and one valuation becomes a different animal at a higher rate and a lower valuation. And when these loans mature, the borrower has to refinance at the new reality. If the numbers don't work, the default isn't a dramatic explosion, it's a quiet handover, a restructure, or a forced sale. Now the question, who holds the paper? Banks, insurers, funds, and structured vehicles. Which means card 4 connects directly to card 5, bank balance sheet sensitivity. When funding costs rise and asset values fall, banks can get squeezed, even if depositors are calm. And that's why, in any environment where commercial collateral is repricing, everyone should watch how banks are responding. Not with panic, but with attention. Mergers, acquisitions, activist pushes, strategic capital decisions. These are not random. They're choices made under pressure or opportunity. And remember the key theme. The system can look calm on the surface while the base is rearranging. Now, evidence card 6.
The market's hidden engine, corporate buybacks and systematic flows. This matters because it explains the paradox on your screen. You can have heavy insider selling and still see price strength because other buyers are stepping in. When a company buys its shares, it creates demand that doesn't care about your emotions. When passive funds receive inflows, they buy mechanically. These flows can support narrow leadership even when broad conviction is fading. So the hook question becomes, if the market is being held up by mechanical buyers, what happens when the mechanical buyers slow down? Not saying they will, just saying that's the real lever. And this is the time to introduce the most important concept for this entire niche. The concept that separates real analysts from fear merchants: liquidity. Liquidity is not just how much cash exists. Liquidity is how easily risk can be transferred without moving price. Liquidity is the oxygen of markets. When oxygen is plentiful, even weak companies can look strong. When oxygen tightens, the market starts punishing fragile structures. Insiders don't need to predict the exact timing to understand this. They just need to see that oxygen is no longer unlimited. Now the micro answer. This is why the "not where you think" is often about liquidity sensitivity, not just industry labels. The most meaningful selling often clusters in places that need easy liquidity to justify their valuation.
Now we add a new locked door, because we're going deeper and we need a climax later. Locked door 1. What is the single easiest metric to watch that signals liquidity stress before headlines? Locked door 2. What is the simplest way to map insider activity into a heat map you can actually understand? Locked door 3. What is the one mistake retail makes that turns insider selling into a self-inflicted wound? Keep those 3 locked. We'll open them later, but not yet. Now I want to give you a mini case file so this doesn't feel abstract. This is not about one specific company, it's a pattern. Picture a company in a hot narrative sector. The stock is near highs, the story is everywhere, analysts keep raising targets, retail is excited, options activity is loud. Then you see insiders selling. The internet screams, they know something. But here's what a real investigator does. First, they check if the sales are scheduled, option-related, or discretionary. Second, they ask if insiders have been buying at all. Third, they check whether the company itself is buying shares. Fourth, they ask what the company needs from the macro environment to justify today's valuation. Does it need perfect margins? Does it need continuous demand? Does it need cheap capital? Does it need a generous multiple? If the answer is yes to several of those, then insider selling is not necessarily a crash signal, it's a risk management signal. It's someone saying, I'm paid in this stock, I'm concentrated, and at these multiples, I can reduce exposure without changing my lifestyle. Now here's the question that keeps you watching. If that's the loud selling, where is the quiet selling that actually matters? Let's talk about the quiet selling. Quiet selling looks like this: directors trimming across multiple companies in the same stress chain, CFOs reducing exposure when refinancing risk is rising, executives in consumer credit-sensitive businesses reducing exposure when delinquencies creep. People inside industries that depend on heavy capital spending reducing exposure when CapEx starts to collide with margins. And the reason quiet selling is more telling is because it's less likely to be purely lifestyle and more likely to be a response to the machine. Now we introduce evidence card 7, consumer credit and confidence. You can get a weird split reality where markets feel rich, but households feel squeezed. And when households are squeezed, companies with demand sensitivity can see it early. That shows up in internal metrics before it shows up in official reports. If you run a business with transaction data, you see the micro trend. That's why the smartest insiders don't wait for the headline. They see it in real time. Now ask this. If a CEO or CFO sees demand softening and margins compressing, do they want maximum exposure while the stock is priced for perfection? Or do they want optionality? Again, optionality. And that takes us to evidence card 8, the yield curve and the signals people misunderstand. Everyone loves to say,
Inversion equals recession. But the real question is timing and transmission. Sometimes the economy can stay resilient longer than models expect, while excesses build quietly. And that's why you don't use one indicator as a calendar. You use indicators as a weight on probabilities. Insiders do this instinctively. They don't need certainty, they need odds. Now let's build the drama with a new micro hook. What if the next surprise is not a crash, but a rotation so violent that it feels like a crash only if you're positioned wrong? That's important because the content niche you're entering thrives on surprise. Most viewers are not prepared for the idea that their biggest risk is not market down, it's my basket down while the index is fine. That happens when leadership is narrow and rotations are brutal. And insider activity can hint at where that rotation is forming. Now we're going to the core of your video title again.
Most people think insiders are selling in one place. The crowd imagines tech. But the better map is two-dimensional. Axis 1 is narrative crowding. Axis 2 is refinancing sensitivity. The hottest danger zones are not necessarily the hottest tickers. They are the intersection of high multiples and fragile funding. That's the where. Now I'm going to give you a tool you can visualize while listening. Imagine a grid. Top left, high multiple, low debt. That's expensive but not fragile. Top right, high multiple, high debt. That's expensive and fragile. Bottom left, low multiple, low debt. That's boring but resilient. Bottom right, low multiple, high debt. That's cheap but potentially distressed. Insiders tend to sell most aggressively in the top right when uncertainty rises, because it's where the downside gets ugly fast. They may also sell in the top left if the narrative is crowded and they're over-concentrated. And they sometimes buy in the bottom left because it's underappreciated resilience. This is not a rule, it's a map. But it's a map that will make you smarter than 90% of finance content. Now, I promised we'd open the locked doors later. Not yet. First, we need the skeptic again, but stronger this time, because the audience in this niche loves to argue. The skeptic says, none of this matters because insiders can be wrong. And that's true. Insiders can sell too early. Insiders can miss huge upside. Insiders can sell for reasons unrelated to the market. So what gives this investigation value? The value is not prediction. The value is in building a framework that stops you from being hypnotized by headlines. We're not saying they know a crash date. We're saying their behavior reveals where they see asymmetry. And if you can spot asymmetry, you can stop being the easiest liquidity in the room. Now I want to insert a mid-video comment bait that feels natural and doesn't sound like begging. Here it is. In your opinion, what is the most dangerous asset right now? Not the most hated, the most crowded. Is it mega cap tech, commercial real estate, high yield credit, private equity, or something else? Drop just 2 words in the comments, your pick, and 1 reason. Keep it short. I read them. Now back to the evidence. Evidence card 9. The difference between institutional and retail time. Institutions can sit through volatility if they're hedged or if they're long-term. Retail often can't because they're overexposed or under-diversified or emotionally invested in one narrative. This is why insiders are selling becomes viral fear content, because it hits a real insecurity. People suspect they are the exit liquidity, and sometimes they are, but not because insiders are evil, because the structure invites it. When stocks are at highs and liquidity is good, insiders can sell into strong demand. That's normal. The question is whether demand is organic conviction or mechanical. And that's where the locked door about the simplest liquidity metric comes in, but we still hold it. Evidence card 10, concentration risk. When markets are carried by a narrow set of winners, the index can hide weakness. That creates a false comfort. It also creates a setup where a small change in sentiment can create big moves in the leadership names. Insiders understand this. If you're a rational actor and your company's stock is at a high multiple
because it sits in the leadership basket. You reduce exposure because you don't need to be the last person holding the most crowded trade. That doesn't mean the trade dies tomorrow. It means the trade is crowded enough that risk is asymmetric. Now we move to the part of the investigation that viewers love, the "What happens next" section. But we will do it responsibly, with scenarios, not prophecy. Scenario 1. Soft landing with rotation. Markets don't crash, but leadership changes.
High multiple, crowded stories underperform. Boring cash flow outperforms. And the index grinds with turbulence. In this scenario, insider selling in story sectors is not a crash predictor, it's a rotation hint. Scenario 2. Credit event. A refinancing wave hits weak balance sheets, spreads widen, defaults rise in pockets, and equities react later. In this scenario, the important clue is not celebrity selling. It's selling and silence in credit-sensitive industries and banks. Scenario 3. Policy or geopolitical shock. Something external causes a volatility spike, and the market reprices risk quickly. In this scenario, mechanical buyers may pause, liquidity thins, and crowded trades unwind fast. The key point is, in all three scenarios, the usefulness of insider data depends on whether you can map it correctly. And that brings us to the second locked door. How do you map insider activity into a heat map that makes sense? Here's the mini answer without giving the final master key yet. You map it by clustering, not by headlines. You watch repeated behavior. You watch who sells and who buys, and you layer it with macro sensitivity. You treat it like an intelligence report, not like a tarot card. Now, the third locked door was the biggest retail mistake. We'll open it at the very end because it's the emotional climax, and it will keep viewers to the finish. But before that, we need to talk about one of the most misunderstood mechanics. Insider selling can be bullish in a weird way. That sounds insane, but hear me out. Insiders selling during strength can signal confidence that liquidity will remain available because they feel safe selling without destabilizing their own stock. And if the company has buybacks and strong demand, insiders can sell and the market absorbs it. That's why you can't treat selling as automatically bearish. It's context. But there is one version of insider activity that is much more concerning, and it's not selling. It's when you see broad insider buying disappear for long periods while valuations stay high. That's not a timing tool, it's a mood tool. It's the difference between "we think the stock is fair" and "we are not eager to add here." And that mood, combined with heavy selling in crowded story zones, is the map. Now I'm going to open locked door 1, the simplest liquidity metric you can watch, because it's time for a payoff. And then we'll lock a deeper door immediately to keep tension. The simplest liquidity metric for most people is not a secret exotic ratio. It's watching whether credit markets are calm or nervous, because credit reprices reality faster. One simple proxy is credit spreads, how much extra yield lower quality borrowers must pay compared to safer ones. When spreads are tight, liquidity is loose. When spreads widen fast, oxygen is thinning. You don't need to trade it. You just need to respect it. Now I'm going to immediately lock a deeper door. What is the one thing that makes spreads widen suddenly? Not the headline, the funding stress, the rollover moments, the forced selling mechanics. We'll come back. Now, because you asked for maximum mass for voiceover, we can't just repeat concepts, we have to add density. So let's go deeper on the "not where you think" and make it surgical. When people say insiders, they imagine CEOs, but many meaningful signals come from directors and major holders across mid-cap and small-cap companies that depend on the economy, not the hype. If you see repeated selling across industries tied to construction, business services, lending, transportation, discretionary consumer spending, and leveraged real assets, that's a different message than "founder sold into an all-time high." It says the people closest to operational cycles are de-risking into strength. Now, if you want to make this entertaining, you frame it as a detective story with suspects.
Suspect 1. AI euphoria.
Not because AI is fake, but because markets can price decades of perfection into a few years. When that happens, the risk is not that the technology disappears. It's that expectations get too far ahead of reality. Insiders sell when expectations are most generous. Suspect 2. The debt wall. Not because debt always kills companies, but because refinancing at worse terms can compress margins and increase default risk. Suspect 3. Commercial real estate maturity pressure and bank exposure. Not because every bank fails, but because pressure forces behavior changes, and behavior changes move markets. Suspect 4. Consumer fatigue. Not because demand collapses overnight, but because squeezes show up in internal data before they appear in headlines. Now here's a micro hook we can add that will keep viewers. If you had to predict the next wave of earnings surprises, would it come from companies that sell wants or companies that sell needs? That question makes people think. It makes people stay. And here's the mini answer. In uncertain regimes, needs tend to be steadier, wants tend to swing, but the market often prices wants as if they're needs when mood is euphoric. That's where asymmetric risk forms. Now, here's a key retention trick you can use every video in this niche. You say, I'm going to show you the exact test that separates meaningless insider selling from meaningful. And then you delay it. We're going to do that now. The exact test is simple, but we're going to earn it. First, one more evidence card: timing windows. When you see synchronized selling across multiple leaders at similar times, it's often because windows open after earnings, after lockups, after plan triggers, or after major narrative milestones. You can read it as coordination. It's usually just windows. But it still matters because it tells you when liquidity is being used. The market is a liquidity machine. People do what the machine allows. Now, here's the test, the thing I promised. Meaningless insider selling usually has at least one of these features. It's part of a pre-scheduled plan. It's tied to options. It's small relative to holdings. It happens regularly. And it's not clustered across multiple insiders. Meaningful insider selling often has different features. It's discretionary. It's unusually large relative to the insider's stake. It's clustered across multiple insiders. It happens near narrative peaks or valuation extremes. And it appears in industries about to face a stress change shift. That's your test. Not perfect, but better than the internet. Now, the third locked door, the biggest retail mistake. We open now because it's the emotional core of this whole niche. The mistake is treating insider activity like a copy trade instead of a context signal. Retail sees selling and tries to sell everything immediately, or they see buying and try to buy everything immediately. That's not intelligence, that's mimicry. And mimicry is what turns you into exit liquidity. The correct use is not copying. The correct use is adjusting your questions. If insiders are selling in a crowded story sector, you don't have to panic. But you should ask, what assumptions are priced in here, and what would break them? If insiders aren't buying across broad sections of the market, you don't have to predict a crash. But you should ask, what is the probability of disappointment rising? That's how you become an adult in the market, not a headline addict. Now, I want to deliver a final, high-value framework sentence that viewers can repeat. In this niche, repeatability equals virality. Here's the sentence. Selling tells you where people are taking chips off the table, but buying tells you where conviction is returning. That's the soundbite. Now, we close with a second subscribe bait, different from the earlier one, so it feels natural. If you want me to turn this into a weekly evidence board where we track two things only: where insiders are selling in clusters, and where insiders are actually buying with conviction, and we connect it to the stress chain so you're not watching the wrong fire, subscribe. Because once you see the map, you can't unsee it. And last comment bait, different and specific. What is one indicator you want me to build into the evidence board every week? Insider buying clusters,
Credit spreads, bank stress signals, commercial real estate maturities, or market breadth? Pick one and write it in the comments, and I'll use the top answer as the backbone of part 2. Final disclaimer again, because this matters. This is not financial advice. This is education and pattern recognition. The goal is not to make you scared. The goal is to make you harder to manipulate by narratives. And if you remember only one thing from this entire investigation, remember this. The question is not whether insiders are selling. The question is where they are selling, where they are not buying, and what assumptions the market is paying for in those places. That's how you stop watching the market like a movie and start reading it like a system.